Welcome to the Deep Dive, the place where we take massive stacks of source material and deliver the foundational knowledge you need to be expert in the room, fast. Our deep dive today is focused on two technologies that, while seemingly separate, are inextricably linked in the modern digital economy. We're talking about blockchain and the fundamental programming language that makes these systems accessible, JavaScript.
It's such an essential conversation because blockchain at its core, it solves the problem of trust in a digital world. And JavaScript,
Yeah.
it solves the problem of usability. When you look at the history of finance, the whole shift from, local economies to centralized banking was supposed to stabilize everything. And yet we've seen 7 major financial crises just between the Great Depression and the Great Recession.
And that history of centralized failure is exactly why we need this dive. It speaks to a profound systemic vulnerability.
Precisely. Blockchain was born from that necessity, from the need to create digital trust without relying so heavily on a fallible central authority. It's really a mechanism for digital consensus.
So to guide you through this, we've pulled together material on everything from, well, the math of decentralization to the actual code that makes it all usable. We're going to unpack the mechanics of the digital ledger, see how it's revolutionizing everything from banking to supply chains, and then, and this is critical, we'll show you how the core programming tools, specifically JavaScript, build the necessary bridge to allow you to interact with these secure, decentralized systems.
Okay, let's unpack this then. Where did the idea of this secured chain of records actually begin? It's much older than Bitcoin.
Absolutely. The foundational concept was laid out way back in 1991 by Stuart Haber and W. Scott Stornetta. And their goal was purely academic, really. They just wanted a computationally practical way to timestamp digital documents so that nobody could backdate them or tamper with them without being detected.
So the original mission was all about immutable proof, not currency. Correct. And then they improved on it pretty significantly in 1992 by incorporating what are called Merkle trees. This structure made it possible to collect multiple documents, so multiple transactions or pieces of data, and store them efficiently and verifiably in a single block.
Hold on, why is the Merkle tree a big deal? Isn't it just a way of organizing data?
It's a lot more than just organization. It's about efficiency and verification. A Merkle tree creates a cryptographic hash of all the transactions in a block. And then it combines those hashes over and over until you're left with just one single hash, the Merkle root. This means if you want to verify that one specific transaction is in that block, you don't have to download and check every single transaction.
Ah.
You just need a small set of hashes leading up to the root to verify its integrity, and you can do it quickly. That efficiency is absolutely key to scaling a decentralized ledger.
That makes the system viable. So let's fast forward a decade. The patent on that tech lapses, and that brings us right to the moment where digital records meet digital money. But the problem of double spending had to be solved first.
That was the major hurdle for any truly digital cash. So in 2004, Harold Finney launched something called reusable proof of work, or RPW. It actually solved double spending by tracking token ownership on a central server. That allowed for immediate validation that a token hadn't been spent somewhere else.
So RPW proved the math could work, but it still relied on a central server.
Exactly. It undermines the whole goal of decentralization.
Right.
The final leap came with the 2008 white paper by the pseudonymous Satoshi Nakamoto. This paper introduced Bitcoin, a fully decentralized peer-to-peer electronic cash system. And it achieved this by using a different mechanism, the Hashcash proof-of-work algorithm, which let the entire network agree on ownership without any central server. The first block, what we call the Genesis block, was mined on January 3rd, 2009.
Okay, so let's clarify for you listening, what is a block and what really makes it secure?
Well, think of it as a shared append-only logbook. Every single block has 3 core non-negotiable components. First, the transactional data itself. Second, the block's hash. This is a unique cryptographic signature for the block's contents. And crucially, if you change even one tiny piece of data, the entire hash changes completely.
And the third piece is what ties it all together, right?
Correct. The third component is the hash of the previous block. That's the link that actually creates the chain. If block B contains the hash of block A, and you go back and tamper with block A's hash changes. So the hash stored in block B is now invalid, which breaks the integrity of the entire chain moving forward.
That structural integrity is incredible, but what stops someone with enormous computing power from just generating all the new correct hashes for the blocks they just tampered with?
And that's the genius of proof of work, or POW. POW is designed to intentionally slow down the building of new blocks. It makes finding that new valid hash really difficult, requiring a massive amount of computational power. So an attacker wouldn't just need to tamper with one block, they'd have to redo the entire POW for all the blocks that came after it.
And do it faster than the rest of the honest network is building new ones.
Exactly. This computing effort makes tampering economically and, well, computationally impossible after a block has been confirmed.
That's the fundamental security layer. Okay, so moving away from just currency, what was the next logical evolution for the chain concept?
The big breakthrough came when developers realized they didn't just have to put transactional data on the chain, they could put code on the chain. And this realization, it really belongs to Vitalik Buterin, who in 2013 started developing Ethereum. He saw the need for a scripting language to build truly decentralized applications, or dApps.
Which of course gave us the most discussed innovation in the space, smart contracts.
Smart contracts are phenomenal. They are code scripts implemented directly onto the Ethereum blockchain, specifically the Ethereum virtual machine, the EVM. They automatically execute transactions or functions when specific predetermined conditions are met, all without needing a traditional intermediary. Think of it less like a traditional contract and more like a high-tech vending machine.
That's a great analogy. You put in the required input, your money, and if the conditions are met, you selected a soda, the machine automatically executes the output and dispenses the product. But if the code is the authority, how do you make sure that code is flawless? That code runs forever, doesn't it?
That raises a critical point about security in dApps. Once a smart contract is deployed, it is immutable, meaning if there's a bug, you can't just patch it like you would with traditional software. So we have to rely on really rigorous auditing and testing before deployment. This permanence is why mistakes can be, well, catastrophic.
Okay, so moving on to the architecture, because not all blockchains operate the same way. There are different types based on how permissioned they are.
That's key for understanding the ecosystem. You have public blockchains, like Bitcoin or the main Ethereum chain. They're fully open source and permissionless. They're decentralized, meaning no single point of failure. And they rely on consensus algorithms like proof of work or proof of stake to validate transactions.
And then you have cases where a business might need the security of a chain, but not all the openness.
That's where private blockchains come in. These are invitation-based. They have a central administrator that governs access and sets the rules. They often use what's called proof of authority, and they're tailored for secure business environments where you don't need total transparency, but you do need that internal immutability.
And the middle ground.
That would be the consortium blockchain. It's a semi-permission hybrid. Control is shared among an authorized group, maybe a collection of banks or supply chain partners. It offers a degree of decentralization while still maintaining the privacy needed between the members.
So connecting this back to you, the learner, why should you care about these different types of chains? What's the practical payoff here?
Oh, the real-world impact is vast. In finance, cutting out the middleman makes cross-border money transfers incredibly cheap and quick. For instance, moving money from the U.S. to the Dominican Republic can happen in minutes, not days. And smart contracts enable things like guaranteed loans and immediate processing.
And it goes way beyond finance. This is transforming industries that traditionally rely on, mountains of paper.
Exactly. Insurance uses smart contracts for transparency and automated, faster payouts. In real estate, the tech can minimize paperwork and dramatically speed up transactions. For storing personal information like medical records, the immutable structure improves security and can help avoid misdiagnosis from bad data. And critically, in supply chain and logistics, the data integrity means items can be tracked from origin to destination without fear of the data being modified.
So that is the decentralized backend, the ledger, and the code that runs on it. But to access that data, to call those smart contracts, to present all of that to you, the user, we need a common language.
And that is where JavaScript steps into the spotlight. JavaScript is the fundamental language of the web front end. It's what converts a static HTML document into the interactive, dynamic application you use every day, whether you're scrolling social media or signing a transaction on a dApp.
And how does JavaScript actually interact with the structure of a web page to make those changes happen?
It relies on something called the Document Object Model, or the DOM. Think of the DOM as the structured blueprint of the web page. It shows JavaScript exactly what elements are there, the buttons, the text fields, the images. JavaScript then uses an API and application programming interface to manipulate those DOM elements, to change their appearance, add functionality, or listen for user input.
So the DOM makes the front end interactive.
Mhm.
But how does this general purpose web language suddenly become, cryptographically aware and able to talk to something as technical as the Ethereum virtual machine?
That is the critical piece of the puzzle. JavaScript needs an interpreter, and that's the role of Web3 libraries. Libraries like ethers.js or web3.js are essential developer tools written in JavaScript. They allow the front-end code to communicate directly with the decentralized network.
Okay, let's drill down on that. What does that communication actually look like?
So when you, the user, click a button in a dApp to execute a smart contract function, say buying a token, the JavaScript code uses that Web3 library to format the request. It turns it into a readable instruction for the EVM. And crucially, the library facilitates the signing process, where your crypto wallet securely adds your private key signature to the transaction to prove ownership before broadcasting it to the network.
So without those libraries, the browser just couldn't speak the language of the chain.
Not at all. They're the bridge.
That makes the integration perfectly clear. So now let's look at how developers arrange the code itself. We talk about programming paradigms, and they seem especially important in this kind of security-critical environment.
Oh, they absolutely are, because the paradigm defines the structure and the behavior of the code. We covered three major ones you see in JavaScript. Procedural programming is the simplest. You just break the program into functions that are executed chronologically, step by step.
Then you move to a more organized, data-focused approach.
That's object-oriented programming, or OOP. This focuses on classes and objects, using principles like encapsulation to hold information inside an object. OOP is generally better suited for huge programs that require constant maintenance and have a lot of complex relationships.
But when you're dealing with smart contracts, which run on the EVM, the sources suggest that developers lean towards a third style. Why is that?
That's functional programming. It focuses on pure, immutable functions. In a functional approach, a function's output relies only on its parameters, and it doesn't cause side effects anywhere else in the program. This immutability and predictability are highly valued in smart contract development because they drastically reduce the attack surface. If you know exactly what the code will do every single time, you can write much safer logic.
That direct link to security is a great insight.
Mm.
Now, given how much heavy lifting JavaScript is doing, are there tools that simplify the front-end developer's job?
Yes, and historically, the library that made web development so much more manageable was jQuery, which came out in 2006. It got incredibly popular because it simplified common, repetitive tasks like complex HTML and DOM manipulation. It allowed developers to basically consolidate what would have been multiple lines of raw JavaScript into single, elegant lines of code. It just made everything easier.
So what does this all mean for someone wanting to get into this rapidly growing field, integrating these back-end concepts with essential web skills?
The demand is just undeniable. The market tells a really compelling story. We've seen demand for blockchain developers spike nearly 2,000% in recent years. It's one of the most sought-after skill sets in tech, with median salaries around $154,550. The entire market value is projected to hit $20 billion by 2024. The opportunities are they're massive, and they're urgent.
And within that demand, there are different roles. You're not just one kind of developer.
Exactly. You have to differentiate between the core blockchain developer and the blockchain software developer. The core dev is the architect. They focus on protocols, consensus mechanisms, the underlying distributed ledger technology itself. They need deep knowledge of cryptography, hash functions, network design.
Whereas the software developer takes those rules and builds the applications that we, the consumer, actually use.
Correct. The blockchain software developer implements the smart contracts, often using languages like Solidity for Ethereum, and then uses JavaScript and those Web3 libraries to develop the front-end and back-end dApps that connect the user to the chain.
Now, we've focused a lot on the security of the chained hash structure, but despite that robustness, there are still serious security risks.
That is essential to understand. The security of proof-of-work networks relies on decentralization and the massive cost of tampering. But a major risk is the 51% attack. This happens if a single entity, or a colluding group, gains control of over 50% of the network's total mining capacity.
And if they get that majority control, what's the specific damage they can do?
Well, they essentially break the entire trust model. With 51% control, they can censor transactions. They can just choose which ones get confirmed and which don't. More critically, they can engage in double spending. They could spend coins, wait for it to be confirmed, and then use their majority power to rewrite history, delete the original spend, and spend the same coins again.
Which undermines the entire currency.
Completely.
And we can't talk about POW security without addressing the incredible energy costs that's needed to secure it.
The energy consumption issue is an enormous hurdle, both philosophically and practically. Sources indicate the Bitcoin network alone consumes power equivalent to about 2 million average U.S. homes every year. Now, proof-of-stake consensus mechanisms address this, but for the big POW chains, that power usage is a crucial economic and environmental factor.
So for you, the learner, looking to start this journey, where should you begin? It's clear you need to master both the theory and the code.
You have to start with the theoretical basics, really grasp the architecture, the protocols, the difference between PowerW and POS. Then move to coding. While JavaScript and Web3 are crucial for the front end, for the core logic, a language like Solidity is highly recommended for writing smart contracts on Ethereum. The key takeaway is that real problem solving in this domain comes from truly knowing the underlying cryptographic and theoretical concepts, not just memorizing syntax.
We've covered a remarkable journey today, charting the need for trust from the centralized financial crises of the past to the decentralized consensus of today, where the ledger itself is the authority. We've seen how that integrity is maintained by computational work and how versatile languages like JavaScript, bridged by those Web3 libraries, make the whole system usable for everyone on the web.
And this whole notion of embedding trust into code, rather than relying on human institutions, leads us to a final provocative thought for you to consider. Blockchain security model relies on the self-interest of its participants, miners wanting rewards to protect the network's integrity. It results in shared secure records without anyone needing to communicate. It's a system of secure transparency based on individual self-interested contribution. So if this model proves to be fundamentally more resilient for digital currency than centralized banks, what other vast non-digital centralized systems, electoral processes, legal registrations, even institutional governance could be fundamentally redesigned using that model of self-policing distributed trust?